Okay, good evening, everyone. This is Ken Long from Tortoise Capital Management with a review of the weekly strategy report for June 11th, 2011. And I want to start with the weekly report. We had a state change on Friday, on 6/11/11. We moved out of bullish territory into sideways normal, and that's the first time we've been out of bull territory for 9 months. And what that means is that when the market's in sideways, on average, tomorrow is flat, and there is less of an advantage in staying overnight. This should tell us that the market is vulnerable now because it's very close to its 200-day moving average and is therefore subject to additional correction, which can lead to a baby bear of greater than 10% drawdown and a mama bear of 20% or more. So this tells us that in our shorter-term systems, we should be more willing to cash the winning trades during the day and carry less risk overnight because there's no statistical advantage to being in the market overnight. On an annual basis, using weekly RSI 14, the market's at 47 out of 100. It's dipped under 50 for the first time in a long while. 10-day NDX, the market is at 4, and so it's oversold on a short-term basis. The stretch above the 200-day moving average is coded red. It's at 1.79%, and that's what shifts us into sideways conditions. The slope of the 50-day moving average just went negative. It's coded red, and it's now minus 0.26%, and that's bearish. Those two indicators have been signaling us of continuous market weakness over the last 6 weeks. And so paying attention to the market mosaic indicators on a daily and weekly basis should be giving us enough warning to tighten up our stops, to reduce our exposure, to hold them, cash them when we get them more often, and that's how I've been using them. ADX 14 has increased now to 22. It is the beginning of a trend, and with minus DI stronger than plus DI, it's clear that it's the bearish price action that's beginning to dominate. ATR percentage has increased to 1.23% at the high, excuse me, the high end of normal. Market, again, sideways normal conditions, oversold. Equities sold off hard this week with increasing volatility, and we slid into sideways. The 50-day moving average slope and 30-day regression channel were violated to the downside this week, so weakening all over the place. Lisa asked, why do we hold things like 331 and ETF2 during times like these? Because the rules protect us against catastrophic drawdown, and the rules have told us, have not yet told us to exit those. ETF2 is at 20% exposure rather than 100%, and so it has actually incremented us out of risk. 331, I did some exhaustive testing on 331 for the seminar here, and what I would tell you is that the 200-day moving average turns out to be an important one. And when the individual components go underneath their 200-day moving average, it's a good idea to move to cash in those positions. We're holding IYR, EEM, and TLT. TLT is not close to its 200-day moving average. If you want to, upgrade, if you will, to the 331 modified. That you could put a 9-month moving average on those, or a 200-period moving average, and use that to guide you during the week or during the month ahead. Excuse me. 631 is holding the IYR real estate, mid caps and small caps. This is what I consider to be an example of the difference between a 3-month and a 6-month look back. The 331 has already incremented us out of the equities in 2 out of the 3 positions. IYR is an alternate target with U.S. home builders, or real estate, excuse me, and TLT is the Treasury. So the 331 became more sensitive to the rolling over of the market, and so that's why I tend to prefer that shorter term posture. And whereas 631 still is 2/3 in equity. So my recommendation is that the 331 is still the better and more sensitive system, and then by adding the a 9-month moving average filter, turns out to be very robust and very favorable. Pardon me. The theoretical exposure in ETF2 is 0%. All of the regional indexes are negative. Model portfolio is at 20%. I'm recommending that we hold on to XBI and I think it's IHF, the 2 position. One is a healthcare and the other one is a biotech. Both of those are extremely strong. They're rated in the green. They are a considerable distance away from their stop loss. They actually held up very well during the sell-off this week. And then if the market holds at the 200-day moving average, those 2 positions will do fine. And so I respect the stop losses on those 2, and I suggest we keep holding those. Pardon me. Moving on. I want to look at the market health check now. And again, you can see the vertical blue lines are 10, 20, and 30 days of look-back period. The horizontal purple line is the previous swing high at 137. The dotted purple line is the previous swing high at about 134.5. And it's also right at the top of the regression channel, as you can see. The center black line is the slope of the 30-day regression line. You can see it's pointed down. The outer black lines are the regression channel formed by the maximum excursion from the regression line. I want you to, I've made a slight distinction now on how I'm using that regression channel. I've been thinking about some things Dr. Gil Raff and I spoke about on this, and so I've offset the channel by 1 day. And what that allows us to do is take a look at the most recent day with respect to the previous channel to see if it violates it or not. There was a day back here on the one that I'm highlighting right now, actually violated the previous regression channel, which looked like this highlighted note. And so that, when it broke below the previous day's regression channel, that was an indicator of a increase in the bearish selling, and that a further break to the downside was likely. And that's what we ended up seeing, with a little pullback and then an additional fail. So now I've offset that regression channel by 1 day to give us the ability to quickly look at today's price action and compare it to the previous regression channel to see if there was any change made. This is similar to the idea that I use with Williams %R and versus the NDX, which doesn't use today's price action to calculate the boundaries. And I like the way that works, and so that's going to be a continuous feature. Now, something else I want to highlight is the appearance of the 200-day moving average. It's this shaded area here right down at the bottom. I don't draw it as a line because I want us to see it as an area. and to be very, very respectful of its location. And we haven't seen it on our chart for a long while because the market had pulled away from it during its historic run-up. But it's now crept back onto the chart, so we got to be careful about it. At the same time, we can see the long-term Williams percent R has finally come out of overbought and dipped back into the high range of normal. And the Williams percent R10 shows us oversold for a long period of time now. And so what we have is a market that has crashed through the range, the noise range, which was 5% below the previous swing high, and it's on its way now down to test, I think, the 10% pullback. You can hear the commentators now talking about this being simply a normal correction in a bull market and not to worry. That's what Lou Dobbs was saying. However, that's real money, that it has fallen about 8% from the swing high and is now only, and we're in the sideways, and now it's so close to the 200 that we should continue to be very respectful of this change in state. The next real serious support level I see comes at 126, going all the way back into March, and the low around the 15th of March at 126, and that's the only thing holding it above the 200-day moving average right now. It's pretty weak support. So looking up on top now on the ADX, you can see the strength of the bearish selling action. So the plus DI has drifted under ADX while the minus DI is well above. And you can see ADX, which had bottomed below 15, is now crossed 15, is now up into the low 20s with minus DI firmly in charge. This is what the early stages of a bear market looks like. Not saying that it is one yet, because we're still in sideways, but certainly cause for concern. If you flip this chart over, you would look at this bearish move here certainly as a strong enough trend to trade on the long side. So when we flip it back over, there's very clear evidence of at least of a test of 125 in the short term. Moving on. Taking a look now at the summary of the ETF2 regions. All of them are negative on the 5-week rate of return. That's why we're at 0% invested, 100% cash in the theoretical model. Sideways normal. EFA continues to be better than SPY, so the global is better than the U.S. Inside the U.S., the order of merit is mid caps, large caps, technology, and the small caps. Right now, I'm trading the small caps on the short side. And that's what my wife's been doing this week to in pretty good effect with the frog technique. Strongest sectors are IEV, which is the European 350, and then U.S. mid caps. Weakest sectors, Latin America, which is below its 200-day moving average, and EWJ, Japan. Moving on. Taking a look now at the world market model. And what I want to highlight is the strength in the Swiss franc and the strength in Switzerland. We're going to take a look at a what I think is a pretty nice channeling type setup for Switzerland. This is definitely a flight to quality and a defensive play going to both the country of Switzerland and their currency. You can see the whole U.S. has gone into yellow, below average. The other asset class is doing very well, with commodities all the way through corporate bonds doing very well. In Asia, it's Malaysia, Singapore, Taiwan, India has made a nice recovery. You may recall about 4 weeks ago it was down in the single-digit red, and now has moved above average. China continues to lag the U.S. and the rest of the world. Europe is in pretty good shape on strength of the euro. And then you can see an awful lot of the commodity pairs, the commodity ETFs, currency ETFs, excuse me, all doing very well against the dollar. I'm going to show you in the charts of interest the UUP, which I think has an interesting potential for the dollar to turn around here. If it does, that would be a heck of a trade, and because everybody's on the other side of the trade already, maybe that's the counterintuitive position. Inside the business sectors, even the defensive sectors like staples, utilities, and healthcare have been suffering and are back into the white from the green. The reason they're not green is because there's so many of these other alternative asset classes that are just doing better than equities. When we get to the charts of interest, I want you to pay special attention to the chart on Johnson & Johnson, which is about as healthy a stock chart as there is right now inside the U.S., and even that's been flat for 10 days. But that's when that's the strongest pattern that there is, then that's additional cause for concern. Moving on. The 100 by 200 crossover system, you can see it quickly has reverted almost completely to cash, and so there's something good about that long-term intermediate crossover idea. The only thing that's still on the buy side is XLP, staples, healthcare, gold, and pharmaceuticals. So that's some alternative asset classes for you and some defensive sectors. Moving on. Inside the ETF top 30, the same primaries as we had last week. Swiss franc, healthcare, gold, more healthcare, consumer staples, healthcare, biotech, Switzerland, precious metals, commodities, biotech, high yields, energy, natural gas, farms, silver. Even silver is starting to look pretty good once again. Still very, very liquid. I think the panic selling is over. There has not been a speculative rush. I think this just reflects the new margin requirements and the reduced volume that we're going to see. But it still looks like a store of value to me for the intermediate term. Moving on. That's so much for the weekly. We're going to proceed directly to the daily now. Okay, I'm not going to repeat the top row, so we'll just go straight on to GapStat. 10 times in the last, correction, I guess 17 times in the last 30 days the market has gapped down. 10 of those days it has continued to fail, and the average is minus 0.69. So you can see that we've hit a tipping point on gap statistics. That's really the trade right now, is betting on the further intraday failure, almost regardless of which direction the initial gap is. On the gap up and reversal to close lower has happened 8 times as compared to only 5 times as it followed through. And in this case, the 8 failures have been larger on average than the 8 continuation. So right now the intraday downside trade is still very much indicated. You can see the time series on the 10-day NDX and the daily pivots, which are now down on the spiders to 127.93 and then 78.19 in IWM. Buku signals now for the overreaction and to the channeling system. I'm not taking those on a mechanical basis. I'm considering them, I will take them inside IWM or the Russell's Future if and only if I see strength during the day, because I believe the market is especially vulnerable to another downside move right here. However, I do expect a volatile move in either direction when it happens. And so this favors the shorter term, intraday, one-day trader. And that's where that frog strategy, I think, is really going to pay off. Taking a look at volatility, you can see how it's increased from the edge of quiet all the way back up to the boundary of normal and volatile right now over the past 2 months. And you've seen the ADX increasing and the strength of the bearish selling. Inside 10-day max pain, Cisco, Bank of America, Alcoa, Caterpillar, and Disney, and oil exploration, metals and mining, retail. That's how quickly retail kind of failed. 2 weeks ago, it was an ETF2 holding, meaning it was outperforming, and now it's just gotten stomped on as the economy slows down. 551W in gold, Kraft, and Pfizer. All three of those actually have pretty decent looking charts, have held up pretty well. Triple screen on McDonald's, which has held up pretty well as a consumer staple. A dozen signals in the ETFs for channeling, and basically everything in the Dow almost is a channeling candidate. Moving on. There's sort of an anomaly that we spotted in finance here as the market is teetering on the brink. I want you to take a look at Bank of America, which has been in the 10-day back to the 12-month time frame absolutely horrible compared to the rest of the Dow. But over the last 1 and 3 days has actually turned in some positive divergence. That's something that we should take note of and look for, maybe cycling into finances or play a little short-term momentum there. JP Morgan also in the horrible finance sector, nevertheless turning in 1, 3, and 5-day outperformances. So be open to the short-term opportunity that may present itself in XLF. Pfizer has had a 1, 3, and 5-day down. It's been so strong for so long that I actually consider that to be something like a pseudo triple screen opportunity. Cisco just been absolutely miserable over every measured time period. Hewlett-Packard was a good tactical trade 2 weeks ago. This last week had no follow through, and that's the main reason for not believing in the washout pattern. Go and be willing to trade it, but cash them when you got them, and don't get committed to believing that it's actually going to work. Moving on to the ETFs. Excuse me. Silver gave a little pullback on Friday. I think there may be an opportunity to a little price improvement. Treasuries, natural gas, and the VIX were in the green. You can see the VIX has gone from losing 80% over the last 12 months to now being a short-term defensive play. Treasuries definitely looking strong compared to equities in a flight to quality. Moving on. Slope of the regression line. The more and more I look at this, I just got to tell you, this is such an important indicator for me. I did a lot of reading and prep for this couple seminars I'm doing, and I was in a zone trance state on the airplane ride coming over like I usually do, and I had some hallucinations about the slope of the regression line, and I've come up with some very interesting insights. The important thing here is not just the slope, but also the R-squared reading. When R-squared is above 0.7, what it says is that the slope of the regression line tells a very accurate story of the pattern of the data. And so in this case, when you have a steep downward slope, which is right now by far the worst it's been in the last 180 days, in other words, almost 3 standard deviations below average, and the R-squared is so high, what that tells you is that this really is a miserable move, and that it's absolutely clearly bearish. You can see in this shaded area here on the close-up of the time series how the gap between the regression line slope and its 10-period moving average is getting wider. That means the downward sell-off is accelerating. You can see on percent stretch, we're already now 1.5 standard deviations below average. And if we sell another couple percent and get into bear territory, we will be below the 2 standard deviation level for the first time in a long time. So that's how quickly the bear has evaporated in this last little run. Moving on. Range stat percentages for your reference. The holding X day percentages, and you can see how the whole field has turned to red, and really no joy anywhere. Only Japan, surprisingly, is positive over the last 40 days, and even then a fraction of a percentage. Real estate has held up just about as well as anything, and gold and silver, filling in the difference. You can see the advantage of gold right now. But on a short-term basis, silver has already kind of caught back up to gold, and now that doesn't seem to be any more panic selling in it, I think that's tradable on the long side once more. Moving on. Just a quick look at the quality report. The highlights, the divergences that are in the green are Hewlett-Packard and Bank of America, Pfizer, McDonald's. So those are the stealth candidates that are working these days. Hewlett-Packard, its failure to fail further, in other words, the first successful washout trade, has suggested it may have started to turn the corner. On the next surge up in technology, I would look to see Hewlett-Packard being considered no longer a disaster, but rather a value play. And so that's going to continue to stay on my radar screen as a short-term and intermediate-term trading candidate. Moving on now to the ETFs. The divergences to highlight here are the defensive sectors, treasuries, agriculture, natural gas. The other thing I just want to highlight for you is you can see how extreme results occur at extreme conditions. All the greens on the divergences are down at the bottom among things that were horrible 2 months ago that have gotten better. You can see natural gas has gone from red to green in a short period of time, and then up here near the top, you can see all the red divergences are coming from things that were terrific 2 months ago, but have really led the way down in the past 30 days. So that's sort of an indication the power of paying attention to extremes. That extreme results come from things that start under that are already at an extreme condition. It could be an extreme follow-through, but it could also be an extreme reversal. So that's why I like paying attention to those abnormal portions of the curve in either direction. Moving on. Oops. Gap statistics and safe zone channel for your reference as our pivot points. We took a look at this in the seminar and spent some time on it. This is what I call the alpha stat. We look at the regression line slope of each of these major indexes, and then we standardize it, normalize it by subtracting that of SPY. And so SPY's relative strength is the yellow, or is the zero line, and then you can see kind of quickly the right now you can see the weakness in the U.S. with things going below the zero line, and then the relative strength of the commodities as they have actually started to go into ascendance. And in oil, as an example, that's a 7 standard deviation move on its alpha stat over the last 30 days. And I also want you just to note, for example, the oscillation, the smooth cycling between sectors and then the broader markets. These are things going in and out of phase, in and out of favor on 5 and 10 days at a time. That's how long those little swing trades can last. And so when you see in this kind of a weakening market, you see money being cycled between sectors, it sort of tells you that it's time to be tightening up your holding periods and not waiting for the long trends to develop out of here, except maybe to the downside. That it's better to take the bird in the hand rather than the two in the bush. That's how I read that. What these indicators do is remove that market filter standing between you and what the sector is trying to tell you. So if this is you here at this little dot, and over here is the sector, you've got this market filter in the way, and so by subtracting the market from the sector's regression line slope, you actually get to see directly what the sector here in the S is trying to tell you by getting rid of this market filter. That's the main idea. That's going to be coded in the into Bundle 2 for TradeStation. Bill Brower's hard at work on that, coding up a number of my unique indicators for analyzing the market conditions, sector conditions, and it's looking pretty good. He showed me some prototypes, and so as soon as he finishes that up and we get it tested, we'll make those available to all subscribers at a reduced rate compared to what I'll sell it out on the open market. It's everything that we already have on the Excel spreadsheets and what you see in these weekly reports, but it's something you can use on TradeStation yourself and adapt the parameters for your own particular use if you find it helpful. So I'll just put a plug in for it right there. I'm going to have him code up the short-term strategy that I'm working on too, the frog, because I think that that is really a powerful strategy. And because it's relatively short-term, having an automated execution, scanning and execution platform will be the key to be trading it broadly and at low levels of risk. And so when we get that going, I would encourage you to think about adding that as a standalone TradeStation strategy. We're going to do that as a separate bundle for people that just want to use it for short-term. Try to keep your costs down. But like all my stuff, I will have that fully disclosed to you, so you can implement it any way you'd like. Moving on. I want to shift now to charts of interest. And let me call that up for you real quick. All right, the way I'm trying to highlight the color codes this week, a little bit different than usual. I'm experimenting with different ways of trying to get my point across. What I've highlighted is about the last 2 weeks of price action in the blue, and that represents really, from the start of the month there had been a sell-off, for example, in all of the indexes. I'll demonstrate it here in Alcoa to show you what I mean. We had this, there'd been the first pullback from when the market was at 137 about 6 weeks ago. Sell off, and then there was this little tactical bounce right here. It turns out that tactical bounce was occurring while we were doing the live trading week in Kansas City, this last one in May. And so that's the places where we were able actually, for example, to get Hewlett Packard on a washout and get some tactical trades in. But then at the end of the month and then the rollover, you can see just how harshly everything in the blue has sold off. So what I've done is really taken from the start of the month, 1 June until present, and highlighted that price action in the blue. And then underneath it, what I'm doing is I'm taking a look at the MACD histogram. Now, I'm actually showing this as PPO, the percent price oscillator. It's constructed exactly the same as moving average convergence divergence, except it uses a percentage of difference between the moving averages rather than an absolute value of dollars. And what that lets you do is it normalizes the performance on a standard scale, so we can actually compare MACD between instruments now fairly, in the same way that the NDX allows us to do that using price ranges. So what I've got is the price action highlighted in the blue, and then I'm using a different color codes on the MACD or the PPO histogram here about whether I think it's favorable. If so, I'll put it in green, like I show you down here in Chevron. Chevron is rated green on MACD or PPO because the slope of the fast moving average, the MACD line itself, has flattened out and starting to roll up, and you can see on the histogram that the bars are narrowing. So I actually consider that to be favorable. That's what an upside hook tends to look like. On the other hand, up here in the right corner, Caterpillar I show as being in the red. Why? Because the jaws of the MACD line and the signal line are actually getting wider, and the bars are getting steeper down. So when you combine that with price action, I look at Caterpillar as being red, and Chevron and EPP actually being in the green. So now to get back to the individual charts then, Alcoa has broken to a new 2-month low. It looks horrible. The MACD histogram looks bad. Bad news for the economic sector. Boeing suffering in the same way that Alcoa has, no love there. Caterpillar, Cisco, really all suck too. Pardon my language. A sign of mental tiredness, I think. DBA, the agriculture, has actually been on a little stealth move, if you recall, from the ETF view of the report. And you can see rather than it selling off, DBA has actually improved its price since the start of the month. And this little pullback here to 32.5 actually looks pretty favorable to me because if ag has turned the corner and if we're going to see a flight to safety in commodities, agriculture prices could still go up here. So I sort of like DBA for the longer term. Blended commodities are benefiting from that 7 standard deviation movement in oil because DBC actually is about half of energy. You can see just how much that price improvement has helped it. I'm looking for more out of it. I think oil keeps going up and food's going to go up, so DBC is a nice way to play that. That should be on your short list. It's already above its 20 and is stabilized at its 50. You have some clear support levels below it for framing trades, and you can have a target up here at about 32 or 33 for long term. So I like DBC also. EFA has been better than the U.S. It held support above the previous swing low, even though Friday was kind of pretty sad. But the MACD histogram there doesn't look bad when compared to what we're going to see with SPY. EPP, Asia less Japan, failing and failing broadly. It's not as strong as Japan. It's going to be vulnerable to economic slowdown. And if we see the dollar actually reverse here, I would expect more. I would actually expect some strength in the U.S. and continued weakness in Asia. So that looks to me to be an indication of vulnerability when I look at EPP. Moving on. Brazil has done fairly well compared to the U.S. It's very tradable. I'm going to show you in the charts of interest a nice little short-term trade on it, couple R from Friday. The sell-off has not been as bad. The MACD histogram just closed, but it's not failing. Hewlett-Packard, you can see where I've highlighted the washout pattern that got us up above 37. It's made an orderly pullback here to the same previous support level. If we do get a turnaround in SPY, I still see 38 as a target for it, and that'll be a repeat of the washout pattern. If it could hold right here above 35, it's still going to look pretty good on a relative basis. Latin America about the same as Brazil, but a little bit weaker. And its MACD histogram has already rolled over. If you take a look at the difference between ILF's MACD histogram, where it's already crossed below the signal line, whereas EWZ has only come to the signal line. So all other things being equal, Brazil is slightly more favorable compared to the rest of Latin America. Intel continues to get weak. It's trying to hold on at its 50 moving average, but it's given back all of the gains that it made after the gap up. If it fails through 21 here, it's going to quickly get on down to 20 and be followed by the rest of the weak techs. This has been a pretty good reversal trade here in IWM. It's made half of the cup, if you will. If it could hold here at 78, there's room for it to grow. But breaking down and rewarding weakness has been definitely the way to go. Being directionally neutral on it in short-term trading has been a good idea. Now, this is what I reminded you about. I wanted you to take a look at is Johnson & Johnson has resisted the sell-off very well. Its 10-day trading range back to the start of the month is narrow, and it has not made new lows. 50 is stable and smooth. That's what strength looks like. It's got to turn the corner here. It can't hold up the market by itself, but the MACD histogram PPO is still looking pretty good. And then the other usual suspects here, Kraft is not as bad as the other indexes. Coke, despite a one-day bad selling, has been stable and actually shown signs of growing. And the MACD histogram has rolled over and started to tick up, and it's very close to making an upward cross. So Coca-Cola is getting into the wheelhouse. McDonald's also very stable. It has more room to improve, however, on the MACD histogram. So what I really like right now, Johnson & Johnson and Coca-Cola as being well-established defensive leaders and are postured to be strength leaders if the market is actually able to hold here. Mid caps, which had been the strongest, just failed miserably this past week and well below the previous support level, giving it all back. The MACD histogram just getting wider and wider. Microsoft holding stable at 24. Unlike Cisco or Intel, it's actually done better. It had already failed a lot more during that last half of April and May, so maybe all the pain is gone. I look for Microsoft to be postured to be a tech leader as well. Silver stayed steady in its little tight trading range here. A lot of that panic selling and the high daily volatility you see in the during the sell-off is gone. It's got a very tight range. Oil, this actually, believe it or not, is a 7 sigma improvement compared to the rest of the market. It has fully resisted, as well as anything else has in the past 6 weeks by holding steady. Its ability to resist the downward pressure has been legendary. Walmart was not as strong as the other defensive sectors. I think the punishment that the retail sector got in XRT may have affected that somehow, or it affected XRT. But in any event, Walmart suffered a slowdown. And if you look at that last big red candle on Friday, if that's an anomaly, if it can hold here at 53, heck, you got a really nice entry in a stock that everybody in the world wants to own. So I love me some Walmart on a short-term stalking basis. Sector spider for materials, XLB, trying to put in a base here at 38-ish, but it has a little bit more work to go. MACD histogram is setting up for it. It's sold off and found support, so there's room for it to grow. Energy sector, same deal, holding stable above its previous swing low. Financials have just gotten hammered. However, the last 3 days were not big painful days, and you can see that the MACD histogram is actually rolling over and poised to hook up. If so, if it manages to continue to do that and get stronger than the rest of the U.S. market, look for the leadership to come from Bank of America and J.P. Morgan, which were percent winners over the last 1, 2, and 3 days. Moving on. This is the XL series, and you can see that the defensive sectors of utilities and healthcare and consumer staples have all done better than the growth and risk sides of industrials, technology, and consumer discretionary. So defensive sectors are still the way to go. XOM holding stable, much like the oil price has. Again, it's posture. If we get an upturn in the economy, sure, it's postured to do well, but still, it's in a wait-and-see mode. Okay, I want to shift now to charts of interest, part 2, and spend the last few minutes just giving you a quick highlight of this emerging, adapting frog strategy. See if I can call it up. Okay, here's kind of the down and dirty idea behind all this. I'm going to use Alcoa as the example here. So we're looking at 30 days of daily data in that square. And so from the 30 days of data, I only want to calculate the daily ranges. I'm not interested in average true range because as a day trader, I don't want to take into account the volatility of the gap if I'm not carrying overnight risk. I can only trade the market when it's open, and so I'm interested in the behavioral characteristics of the range, which is how the market behaves between high and the low. After I've computed those 30 days of range data, I'm then going to calculate some statistics. The maximum range of the last 30 days, the minimum, the average range, the standard deviation, and then I'm going to compute the range stat, which is the average range of the last 30 days plus one standard deviation. And then I'm going to calculate the average minus one standard deviation price level as well. I then am going to calculate a range stat divided by standard deviation ratio, because the bigger that ratio, the more likely that we have a frog. The frogs are those candidates that have the greatest range stat divided by standard deviation ratio, because that means that their the size of the range stat move they can make is going to be greater than others when divided by the risk. I'm going to define standard deviation as the unit of noise that is computed from the most recent 30 days worth of data. So if we say we're aiming to capture a range stat move, that's the reward, divided by the risk, that's going to give us a ratio, and it's going to be in this middle blue column here. That ratio tells us that if we can get a range stat move, and if we can use standard deviation as our risk level, that's sort of the R multiple that's available to us, minus 1. So we're going to select our targets our preferred targets based off this ratio, and then we're going to stock those targets during the next day right after the open by waiting 30 minutes, finding out what the high and low of the day so far are, and then looking to stock that. So here's an example. When we compute all those statistics, we're going to come up with, for the 30 days, we're going to find the maximum and the minimum that it has traveled over the last 30 days. And then we're going to define normal as movements that fall between average and plus or minus 1 standard deviation. In statistics, this is similar to what's called a stem and leaf plot, in which the middle 50% of the data is contained in the boxes, and then the 25% of the data north and south of that are considered to be kind of outliers. So the middle thick part of that leaf is considered to be the normal area. So what I'm doing is defining that as that normal area as plus or minus a standard deviation. So now we actually have the possibility of 3 kinds of days. The abnormally small days or abnormally narrow days are going to be those whose range at the end of the day from high to low was more than 1 standard deviation below average. So we're going to call that abnormally narrow range. And then any range that is greater than 1 standard deviation above average, we're going to say is an abnormally large range day. So the range stat is that upper limit to what I would call rational exuberance, and that is any move that goes beyond a range stat worth of move is going to be irrational, because it's statistical, and it's a statistical improbability on any given day. It should only happen like 1 out of 6 days. So that's the unlikely case. Now, it's good for us if we are using exit rules and trading rules that allow us to have a fat right-hand tail. If we get in the direction of the market, whether it's up or down that day, or in the direction of the move up or down, then we have the possibility for a fat right tail. I'm not really worried about abnormally narrow days. Why? Because the price is moving so little that even if we get the directionality wrong, we're only going to have at most a 1R loss. So the abnormally narrow range days are not even a concern from a risk management perspective. So our goal now is going to be to figure out how we can frame 2-to-1 trades if we just simply get a normal move into that green box. And then what we're going to do is we're going to respect that upper limit of the range stat and say, if it hesitates after a range stat move and I'm going to take a professional exit to capture the gain. But if it does happen to go through the range stat and go on to become an abnormally large move, then we will be grateful for the gift, but we won't expect it. We won't change our mind or lose our mind simply because we were given a gift that we didn't deserve, whether we deserved it or not. So we're going to be open to those very fat right tails. What that means is that we can routinely frame a 2-to-1 trade intraday if we use something like 1/3 of the range stat to be our risk level, or if we can be more aggressive using a standard deviation move to be our risk level. And I'm going to show you how that works here in a second. So the general strategy now for stalking the entry during the frog strategy is to wait a half an hour so that the opening shenanigans are over, and then compute the low and the high of the day. Pretty easy to do. It's 10 bars on 3-minute charts as an example. So if we see something that looks like a low of the day has been made, we wait for it to move a standard deviation off the low, and then we buy it with a 1 standard deviation initial stop. And then our hope is that it actually turns into a kind of a day where it's going to move a range stat. If it moves a full range stat, we can capture, in some cases, 3 or 4R during the day. Conversely, it works in the other way exactly the same, and that is if what we have if it looks like we've seen the high of the day and it's starting to fail, as soon as it moves a standard deviation in the other direction, we can go short with an initial risk of 1 standard deviation, and then if we get a range stat move to the downside, which is even more likely these days, then we're going to get potentially a 3 to 4R trade. But if all we get is a range stat move or something quite less than that, we'd be happy to have anywhere from 1 to 2R. If it moves past that the boundary of normal and goes up above, then what we're going to do is we're going to adjust our stop that allows us to capture a portion of the irrational exuberance and resolve not to give back any of the gains that we made down here in the land of normal. There's no way that I'm willing to risk normal gains for what turns out to be a pipe dream or irrational exuberance. That's the secret to capturing professional levels of gain from these kinds of moves. Now, the beauty of this little strategy is it doesn't rely on any previous information of the previous day in terms of high of the day or low of the day or swing trade patterns or anything like that. It only needs to know where the market opens and then 30 minutes of observational data. Let me show you what that looks like now with Alcoa as we continue this example. So on the Alcoa table, what we see is that the range stat is 57 cents and the standard deviation is 14 cents. The maximum range and minimum range were 83 and 15 cents respectively. So the minimum that Alcoa can ever move is 0 cents from the open. And we have the average now at 43 cents. and the maximum of the last 30 days at 83 cents. And with the standard deviation of 14 cents, 43 and 14 gets you 57 for the range stat, and 43 minus 14 gives you this average minus 1 standard deviation as the boundary of a normal move. Now, if we take this stack right here to be the range stat divided into pennies, if you use a standard deviation level of move, then that would be a 14-cent move off the low, would allow you to enter with a 1 standard deviation trailing stop or initial stop, and then you could have 1, 2, 3 moves and a penny, a 3R move available to you at the if you get a range stat. If you use the more conservative 1/3 of a range stat, that's actually a 19-cent stop, and then you would end up buying it at this yellow line, and then you would have 1, 2R routinely available to you. Now, as you take a look at this column, the range stat divided by standard deviation, if you subtract 1 full R from each of those numbers, that tells you what kind of routine R multiple is available in all of the Dow components on the next day the market is open. There is routinely a 3 or better R multiple awaiting in multiple targets inside the Dow and among the Dow, the ETF 30. That's the main idea. Let's take a look at what Linda was doing this week in Alcoa using this strategy. Here's Alcoa. It opens here at the where the green arrow is, and these are 5-minute charts because I can't use 3 minutes on stock charts for some reason. And let's count over 6 5-minute candles to find the 30-minute boundary. So 1, 2, 3, 4, 5, 6. In fact, this yellow box shows you what the first 30 minutes of data looks like. Now, there was a slight gap down. Alcoa went up like a rocket to 1560 and made the daily high, and then sold off just as sharply. And so now at the end of 30 minutes, Alcoa looks like it has put in the high of the day right now with price falling. It looks like the high of the day tentatively is at 1560. Now from 1560 minus 14 cents is actually 1546, or right here where the green arrow now is at the top of that candle. But because I waited 30 minutes, I can't take that short position yet. So Linda did what she was supposed to do and waited for the end of 30 minutes, observed that it had now moved more than a standard deviation away from the high of the day, so she immediately got short on this big red candle when it broke below the double bottom at 1537. She establishes a 14-cent initial trailing or an initial stop, excuse me, which is 1 standard deviation above the entry. Now, the green box represents a 1R distance. So she holds that position, and it turns out that AA fails down here to 1522, which is a 1R move. At 1R, her written rules are to cash half the position, cash 1R in half the position, and then move the initial stop from 1R, minus 1R, to break even. And then her second set of instructions are to sell it before the last half an hour of the day, which is at this red circle, and never worse than the trailing stop or this break-even stop. So as soon as she cashes the 1R, the trade continues for another 10 minutes or 15 minutes, and then starts to reverse against her. She doesn't like that move. She actually takes this stop here at 1R on the second half. It's perfectly acceptable if she had decided to use a 1R trailing stop. She would have gotten where the second green arrow points at the red line, which represents a 1 standard deviation move off of what is now the working low of the day. What Linda actually does is she takes the 1R on the second half of the first position, and then she starts computing a standard deviation move off of the low of the day, which is now at 1517. When it gets to 1531, or the green circle, she goes long, places her stop at the red line, and then is holding this position during the day, and then half an hour before the market closes, she exits at 1535 for a fractional win. She earns 10 cents on 14 at risk, which is 5/7, which is about a 0.6 R. So total deal of the day on Alcoa, 1.6 R. Not too bad, following a simple set of rules. Let's go to the next example and see what we can find. The next example we're going to take a look at is IWM. Its magic number, she calls it the magic number, looks like this. It's 45 cents is the standard deviation, and so that gives us 1, 2, 3, 4 R potential if it makes a range stat move. The range stat is $1.79, so that it works out to about 45 cents for the standard deviation. So the same principle. The maximum it's moved in the last 30 days is 2.79, which is about a 5R move if it does the maximum. So this is what Linda does with the rule set inside IWM. Now I want you to observe how quickly, in this case also, it gets to 1R. If all you're looking for is grabbing your first R of the day, as Mark McDowell showed us during the live trading research week workshop, that's a pretty powerful idea if you can do that consistently. Here's what happens. The market opens in IWM. It goes up a little bit, and then 6 bars into the day, or 30 minutes into the day, it's already rollover started failing. Right at 30 minutes, it has moved 45 cents from the high of the day. So Linda shorts it at 78.45 at the green line in the red circle. She places her initial stop at the high of the day. She holds it, and then within about 1 hour, it makes a 1R move. She cashes half at 78 even, moves the initial stop to break even, and then holds it. Once again, it blows right through that position. Comes down to the low of the day. She doesn't like giving back money, and so she cashes that one back at 1R. She gives back the little 3.5 or 2.5 candles, and then she breaks even. Well, not breaks even, I'm sorry. She cashes an R on the second position as well. She now is tracking this price at 77.80 as the low of the day, and then this yellow square looks like is a 1 standard deviation move off the low. She never gets the entry signal. It started to get close, but she didn't take it because it didn't go a penny above. And so now she tried this, where she took a look at the this is the working swing high. It came back down. She was considering taking a short here. If she had, she would have covered at the red circle, but never got it. She asked me if if she was allowed to do that, and I said maybe next week. So now the IWM comes down now to a new low of the day and starts to reverse. So she tracks once more a standard deviation move off of the low of the day. She gets long at the green circle at 78.10. She cashes a 1R trade with half the position at 78.55. About 45 minutes later, she moves the stop to break even, and then she has to exit sometime before this blue line. She ends up holding it to the blue line, and then cashes about a 0.7R in that one. So the total deal of the day on that trade was 1.3, and she got 1 out of the first one, so 2.3R out of IWM. I hope you see the power of this simple rule set, and I think I am very, very interested in this as a strategy. We may even be doing like I said, a trading for non-traders, intraday trading only seminar just to work on this particular strategy if it continues to unfold like this. Let's see if I can find, I think I had one other, oh yeah, I wanted to show you Brazil. That was the last one. She does not have that on her watch list. I have her working on 3 symbols only, SPY, IWM, the mid-cap, Russell small caps, and then silver. And she and our next door neighbor are working on it. Yeah, Lisa asks, do I have the range stat for the Dow symbols in our daily? Yes, I do, on the auto framer. And if you look, I put that on the previous charts as well. Those are the actual live range stats for the Dow 30 and the ETFs. I now want to look at, just so you can take a look at Brazil. Brazil was even easier. Brazil opened at the high of the day, and in about 25 minutes had already sold through a range stat. The standard deviation was 40 cents. It moved through that. She waited like she's supposed to. Or I waited like I was supposed to, excuse me. And so I get short at 72.50, place my stop 1 standard deviation above at 72.90. About 40 minutes later, cash half at 1R at 72.10, move the stop to no lose. This thick red line is what the trailing stop would look like. Once again, the price goes down a little bit more. Probably exit here when it comes back to the 1R level. I don't like giving up those profits. It does nothing more the rest of the afternoon until about 2 o'clock when it makes a new low of the day at 71.90. It moves the standard deviation off of that to 72.30, where you can enter, and then you place your stop at 71.90, and then you have to exit before the 30 minutes before the close, and it wouldn't surprise me if you sold it at 72.50 for a partial win. That's a half an R. So what you end up getting here, that's what a 1.5 R trade looks like, using just a handful of rules and a simple calculation using the standard deviation of the 30-day range, and then paying attention to the opening, not worrying about the gap, and then having the discipline to wait 30 minutes and then go in the direction of the day. Now, on any of those, I am perfectly happy to go the other direction if that's the way it's working out for the day. The only thing I'm concerned about is knowing what the behavioral characteristics are and working accordingly. Simple rule-based system. I can hear Mark McDowell salivating in the background, and well, he should. Because now, guess what you can do with this when you have a swing trade pattern on the front end of this that gives you an indication about directionality. What I'm showing you were trades that did not even care if there was a swing trade pattern or anything the previous day, and did no extra leverage or any additional ideas. You get even better results on this if you start looking for adding positions when it makes a new low of the day or breaks through pivot points or takes out yesterday's high. There's ways to get even more, but the basic framework of the trade gives you a mechanical way to get into the trade early enough that you can take advantage of its simple behavioral characteristics. By waiting 30 minutes, you get past the shenanigans at the open, and you get to take advantage of any directionality. The use of standard deviation as the definition of directionality is crucial. So I would encourage you to think hard about this and maybe listen to the replay when I hang it on YouTube I will tell you, this is as close to money in the bank as I know. I have been looking for things that I can train Linda on for trading for 15 years, and this is the first. Microphone test. Okay, sorry about that. Hey, that was everything I had planned to say anyway. I just I want to say I've been looking for 15 years to give something to Linda to trade during the day when I'm at work. She's trading this right now with our next door neighbor. 2 or 3 more soccer moms or their buddies are looking to do this too. And my intention is by the August workshop to have a really good set of trades that the ladies have put together, and hopefully have this turned into a we'll have this turned into a trade station system for sure for just standalone execution. Then what you can do is you can dump 100, 200 symbols into that, and then it'll alert you when those moves have occurred. And the beauty is you don't have to execute exactly at standard deviation. This is still a sound system if you decide to go with a third of a range stat. And what you just saw were symbols that did not move even as far as a range stat. None of those moves were exceptionally directional. When you get a powerful move in IWM, like on June 1st, you get a $2.80 move with a 45-cent standard deviation. You're talking about 6R, quick, fast, and in a hurry, and that's on a single position. And then if you start adding some markets money, well, you can use your imagination. Meanwhile, this is my best idea about how to go after 1R, and it had its, I guess, its inception about 3 years ago at our first Traders Workshop, and we called it the snapping turtle, and I've been trying to operationalize it for a couple, 2 or 3 years, and it finally has come together. And this is the kind of thing that came to me in that dream state on the airplane on the flight over here. So that's everything I wanted to cover. It went a little bit longer tonight, but I think it was worth it because it's really a good idea that I wanted to share. And I appreciate you guys hanging in there and all the support you've given us and given me. And I hope to keep thinking of new things for you. I think you're going to like what I do with the range stat. And again, just let me put the plug in for the trade station bundles. I mean, I think that's as auto execute as I can come up with right now. And then we'll take a look at putting the Excel front end into interactive brokers. And if we come up with something clever on that, then I'll be sure to let you know. So until next week, you guys take good care of yourself. Treat yourself nicely. Say a prayer for the folks along the Missouri and Mississippi River and down in Joplin. My good buddy Jason is down there. He works for the Corps of Engineers, and he'll be deployed down to Joplin for 6 months to help them try to dig out of that disaster. So this is a U.S. Army major doing good things for the people. And I'd ask you to keep him and his family in your prayers, and those people in Joplin. So good night and God bless, and we'll see you in the chat room.